Welcome back. You've joined us in the newsroom right here on ET Now, and let's now touch base with the management of RITES. Remember, they reported their numbers in the last hour of trade yesterday, where revenue have seen a marginal uptick of nearly 1.5% on a year-on-year basis, but margins have expanded and EBITDA too has seen a jump up of nearly 23% YOY. Rahul Mithal, CMD at RITES, is now joining us. Rahul, afternoon. Thank you so much for joining us here on ET Now. And as I was mentioning, revenue growth has been tepid, but margins have expanded. Order book position also continues to remain very strong. You received 150 new orders worth about 850 crores in the quarter gone by. If you can take us through what led to tepid revenue growth, what led to margin expansion, and also your order book position profile of how it is expected to shape up going forward.
Good afternoon. Yes, you're correct that if you see YOY, there's been a revenue growth of approximately flat, about 1.5% only. And that's primarily because the turnkey segment of our revenue took a hit of about 90 crores. And the reason being that out of our total order book of 9,090 crores, the 4,300 crores that we have on turnkey, more than two-thirds, or nearly 70% of this order book on turnkey is less than a year old. It's about 8 to 10 months old. And a normal infrastructure project's taking about 3 to 4 years. The actual revenue booking execution at the ground level starts normally by the end of the 12th, 14th month. So the turnkey segment will start generating revenue by, say, Q4 or Q1 next year. We were aware of this, and that's why our very focused approach on trying to maximize the revenue from our export sector and from our consultancy sector. So in fact, 90 crores was the add-on revenue from these two segments. So that's why the revenue growth is flat. But because these two segments are higher margin contributors vis-a-vis the turnkey segment, you see an overall growth in the bottom line as well as improvement in the margins.
Understood. This is the reason we are seeing that discrepancy when it comes to revenue growth and EBITDA margin profile. But since we are talking about exports, your order book currently has about 1541 crore of exports as on the 30th of September. How do you expect export order book to shape up going forward, and which regions are contributing to this?
We broke the gap of about 3 to 4 years of getting our first order on export early 24. And after that, we have set ourselves a target, and we maintained that in the last 7-8 trailing quarters of one export order a quarter. This quarter also, we got an export of locomotives to South Africa of about 160 crores. So we are confident, number one, that moving forward, the way we are targeting geographies in Africa and Southeast Asia, which are the prime key areas for export of rolling stock, we will continue to get orders of one export order a quarter. And this is the first quarter where now the execution has started. So after again a gap of a large number of quarters, this was the first quarter where you saw the booking. The first two locomotives got exported of the Mozambique order, and this will also now continue in the successive quarters. So both getting fresh orders as well as revenue realization from the existing order book, you will see that in every successive quarter now.
Understood. So the export outlook continues to remain very strong from across regions. But when we interacted with you at the end of the first quarter, you did tell us that you expect to surpass FY24 revenue this fiscal. You've reported revenue of about 950 crores so far, or about 1,000 crores so far this year. Will you be able to match up to the revenue growth that you reported last year? I believe the full year revenue was at about 2,200 crores, right? So will you be able to cover up in the second half?
Yes, I agree that this is the best time, Q3, Q4, for execution of all projects at the ground level. So whether it's my turnkey projects, expediting the younger orders to try and maximize the revenue in this FY, as well as consultancy orders, as well as the export orders, trying to expedite their delivery so that maximum possible can be delivered in this FY up to Q4, we are still confident that we are aiming to definitely reach last year's level, both in top and bottom line, and definitely surpass them by a satisfactory level.
Okay, so you're saying that you'll be able to achieve about 1200 crores of revenue in the second half of the year to probably meet the FY25 revenue that you had achieved last year. Meanwhile, since we are also talking about revenue growth, margins have been steady at about 24%. This versus 30% that you had reported in the March quarter. What led to the fall and what is leading to the volatility here?
You see, this particular quarter, as I said, because the contribution was more from the consultancy and the export segment of revenue, which are higher margin contributors. That's why you see an overall higher EBITDA margins. As the contribution from turnkey will successively increase, the blended margins will kind of settle down to we have set red lines that overall the EBITDA margin will not allow them to drop below 20%. And we are confident that on an annual basis, EBITDA margins, red line of above 20% and PAT margins of above 15% is definitely what we'll be able to achieve.
All right. One last question on the consultancy margins that have been stable at 33%. For this segment in particular, do you aim to sustain those margins?
Yes, in fact, consultancy is our core strength. We are a consultancy company. That's our core strength. And as the ecosystem of getting more and more orders on a competitive basis, this strike rate which we have set ourselves of 1 order a day. In fact, this quarter we achieved 1.6 order a day. More than two, that about 70% plus are on competitive basis, both domestic and international. So while we continue to get fresh orders, obviously they are at a tougher margin, and that's why the margins are of consultancy are in the range of about 30-32%. We are sure that we will definitely aim at maintaining an overall blended margins across all our 4 streams of revenue of 20% plus, and keeping that overall objective in mind, we tweak the kind of orders that we take in the consultancy segment so that we get an overall blended margin of 20% plus.
Okay, so overall blended margin guidance of 20% plus, that's the word coming in. Mr. Mithal, thank you so much for taking your time out and joining us here on ET Now and helping us understand what your order book position is and what the outlook is going forward, not only when it comes to domestic market, but also about exports market. That's all the time we have on this edition of the show. Thanks so much for tuning in, but Market Fatafat is coming up next.